Now, let me answer the sole purpose of me making this video. How do we go about making our portfolio using Finviz.com, right? So let me jump right into it. So let's first go to the maps. Okay, so there are 3 strategies that I use, 3 methods basically. So the first one I call is quick bucketing, right? What is quick bucketing? What I do is, I know these are the sectors, right? This is technology, this is communication sector, consumer cyclical, entertainment, electronics, financial. What I did is I go to the technology sector and I know Microsoft is the market leader for that sector, and I just simply take Microsoft into my portfolio. I add Microsoft to my portfolio. Likewise, I go to communication services, look at Google, which is the market leader, and add that to my portfolio. Now, prior to adding it to my portfolio, what do? I see what the performance were trending at. What were they? How did they perform a year back? How did they perform over a period of 6 months? How did they perform over a period of 3 months? So it kind of gives you an insight of how these market leaders are performing. And trust me, of the 3 strategies that I'm sharing, this is one of the most easiest and the safest strategy, right? Because you know that these companies are the market leaders. So unless there's an event that wrecks the entire segment, you know that these are safe to have your money invested in. It's as simple as that. But yes, what I do generally is for example, I currently hold shares I've invested in Microsoft, in Apple, in Google, in Amazon, in Walmart, Visa Inc., and there's one more market leader I have in many. Yes, Abbott, right? And I also have investments in other companies as well. I will explain it to you as and when I come to my other strategies. But this is one of the easiest ways for you to go about it. But what I'd suggest is that you do your bit of research, you do your bit of analysis, track them on a monthly and weekly basis. What I did was I noted down all the companies that stood out to me, obviously with the green shade, the green shade. Oh yeah, I don't have the Finviz Elite version, just a reminder. I'm going on with the normal version, such. So yeah, just track what Microsoft, then go back, check the Microsoft details and see how they've performed, the financials, how strong are they, and then you decide whether you want to invest or not. 1 year, 6 months, what has been the difference, what were the indicators that dropped, did they make the news, were there some major events that have occurred that could have caused the sudden drop or the sudden rise. So you need to understand whether the high or the low is of a substantial significance, whether it's just a one-time event or whether it's something that would change the way the stock is evaluated in the market, right? So that covers our first strategy, which is quick bucketing. Now, what is our second strategy? The second strategy I call shadowing, right? So what is shadowing? Let me tell you. Say for example, I pick one of the companies that I know has performed steadily. Let me remind you, let me stress on this, steady. Across the year, across the half-yearly performance and across the quarter, this company or these companies have performed on a very steady basis. how you define steady is a different thing. Whether they've given out the same level of dividends, whether their P ratio has stayed same, or P ratio should actually drop, so that would be better, right? So it depends on you how you define your steady or stable company. So for example, I chose Apple as my steady and stable company, and this becomes my base company. And what I do is I try to find a list of companies that would fit in the same trend that Apple's stock indicators are performing at. Say for example, let's go to Apple. Say it's Apple, right? You can also click here, sorry. If you have done that, that would have been better. Just hold on a second. So I'm going to show you guys that feature as well. Wow, Biden elbows, Johnson bump elbows. Ooh, that's nice. Let them keep bumping elbows. Yeah, so we are at Apple. Now what I'm going to see is them bump elbows. We're here to learn. Now I see what their indicators are performing at. Look at the P ratio. It's 28.30. Just to revise, what does 28.30 mean? For every earning of $1 from Apple shares, I have to invest $28.3. That's what price per earnings mean. And here you can see forward P is lower than the original P value. What does that indicate? That the company has growth potential, because the forward E is lesser than the P value, which just stands to say that the earnings is going to be higher, which is why. PEG is a decent number, 1.58. That's good. Quick ratio. Look at the EPS, 10.2. For next year is 3.02%. Next 5 years, 17.93. Past 5 years, 7.30. Okay. And ROE, shareholders' equity, it's 111.8%. ROI is 31.7%, which is great. So now what we do is we go back to our stock screener. Okay, we use leave it and scroll to this part, right? And we go to our stock screener. And now what we do is we try to replicate the same indicator ranges, stock indicator ranges that Apple currently showing, so much so that Apple reflects in our bucketing list of stocks, right? So for example, I say P, Apple was 28, so I say under 30, right? Or we can say over 25. Over 25 would be a better indicator. Okay, so from 8,314 we've come down to 1,309. Okay, and we can see Apple is right here. Then what we do is the PEG is, let's say, under 2, 176. Was it 1609? We've come down to 176 stocks. Apple is still there in others, right? Next, let's do one thing. Let's go to the EPS growth, for example. EPS this year is 10.0, next year is 3%. And let's say EPS next 5 years is 17.93%. EPS for next 5 years, let's say over 15%. Oh, it's 165. Let's say under 20%. There's 42 companies. So we brought it down to 42. Do remember, please note, over and under does have a bit of significance. Like, obviously, when you don't pay a lot of thought to it, you're like, oh, it doesn't matter. I just need my number. It just needs to be in the range. But it means a lot when you're applying over and under in your filters. Right, next we will go on, let's say, return on investment. Let's say it was over 30%. I think I realized I was being overly let's say under 35. It's under 35. Under 35. Oh, under minus 35. Sorry, my bad. Over 15%, let's say. Oh, we have 8. Over 10%. 18. Okay, this is a decent enough number to have a portfolio. Now, what does this do is, as Apple is performing, right? The intention of shadowing strategy is just to ensure your base company is in the list of screening that you've done, right? Of the filters that you've applied. And now what you can do is, you know that these companies have these indicators that fall in the range of Apple. You can always go back and check the other indicators and try to get companies that are. Also, do understand this is not the most effective way of screening stocks. Let me reiterate here, this isn't one of the best and the most effective ways, but what it does is it gives you a smaller list to work with, so you can always go and check. So for example, when I do it, the first thing I want to do is check the volume, and if I know the market cap is very small, oh, see, this time it's a pretty decent combination that we've come up with. Most of these are mega mid. Yeah, mega mid. We have low potential, but all of these are billion-dollar companies. Last time when I had done, I got some really small volume companies, small market cap companies. But this is a decent list that's figured out, because again, when I do it, there are times that I take Amazon as my base company here. Like I said, I've used Apple at times. There are some months that I use Amazon as a base company, and there is again, when I choose two different companies as a base company, it's just again what am I defining steady as, right? If I'm talking about steady dividends, or if I'm talking about steady growth, or if I'm talking about the fact that I know that that particular company is investing and it's has a higher potential for growth, and if I just feel like a bit risky that particular point of time, I do look at different base companies. But like I said, what this does is tells you like-minded is the wrong term, like-trended stocks as compared to your base company. And here we have, if in case there are times that the volumes that have been traded are very low, right? If it's like in a couple of thousand, like for example, even this volume is not very, the Cable One Inc., right? That's 28,000 shares. No, doesn't really make sense to have this company in your portfolio. You can directly take them out of your portfolio. But what it does is get you to focus on these big companies. Like this is Taiwan Semiconductor, and you have CXC Corporation. Here you have Cargurus, right? So what it does is, with a lot of trials, when you do realize then you can actually come up with your own better list of a more representative list of stocks for your portfolio building, right? That's your second method. So let me take a while and just revisit. The first method we used was called the quick bucketing, where you directly use the heat map and you choose the stocks, the major market leaders, and if they're in green, they've been in green for quite some time, and they generally will be green if they're the market leaders, which just means that their market share, obviously they grow better. But in that case, you can just do that and your list is ready, right? And the second one is where you're shadowing. You choose your base company, and once you've chosen your base company, all you do is apply filters so that your base company comes in your list of filtered stocks, and then you can go about, you have a smaller list to work with, and you can decide from the filtered list whether you want to carry on in your portfolio or you want to drop some of them. But trust me, through my experience, whenever I've used shadowing, I've gotten, at least if I take a list of about 20, so I've gotten like good 8 to 9 stocks in every shadowing list that I've done. So then you have a stronger portfolio built around it, right? And now finally the third one. Now what is the third strategy? Third one is where you apply the indicators yourself. A little more, the reason why I'd say this is a little more difficult than the earlier two methods, quick bucketing and shadowing. The reason why this method, which I call combination sequence, the reason why this is more difficult than the other two is because this, you would have to understand how these different stock market indicators play with one another, how they act, and how a combination of these stock market indicators would give you a more consolidated list of the kind of stocks you're interested in, right? What I can do is I can show you 2 trials which I use to find growth companies, and what has worked for me for quite some time, right? And also there is an option for, I have an option for even day traders, for example. When I say day traders, the reason being you want to find stocks that are efficient or are something that you want to focus on, just because if any one of you are out there or interested in day trading, then I'd want you all to probably have this as one of your ways to filter out, right? Just a suggestion, that's all. So now moving on to how do we find growth stocks through combination sequencing. So first what I do is, for combination sequencing, I look at these indicators: EPS growth quarter over quarter, sales growth over quarter, EPS growth in the past 5 years, and the sales growth in the past 5 years, right? What I do is I put in standard percentage. I sometimes do apply 25, but I never really got enough to make a portfolio. But yeah, say if it's, sorry, again I did a mistake, over 20%, yeah, sales growth in the past 5 years, 20%. You can use next 5 years as well, right? It's a forecasted, but then that's more about the gut feeling or the analysis. Sorry, not the gut feeling, the analysis of the stock market analyst, right? There's nothing like gut feeling here. Sorry, my bad. I take that back. So here we have 147 stocks that are listed, right? So what do these indicators say? That they say that these companies are entitled to grow. It's very simple. I'm looking for growth growth stocks, and I'm applying filters on the growth. It can't be simpler than that, right? But besides that, if I'm looking for a growth company that has a lot of potential, I would say that even currently it does have a lot of potential in the market. It's not going to happen over the fortnight, right? So I would apply a filter on the current volume as well. I'd say, let's say over 2 million. I have 20 stocks here, right? And let's have a look. All 20 are in one page. Right, you have D.R. Horton, Goldfields Limited, combining. Wait, I didn't accidentally apply company. Okay. So these are my list of 20 companies, 20 stocks that are entitled to grow. So that's how I find my growth stocks, right? Here you can see the PE ratios ranging from different ones. So again, stands to prove that you can't just look at one indicator alone and take a call. You need to see a combination of them. I'll probably take this one out of my stock, again, this one out of my portfolio. I'm sorry, because I currently have a portfolio that's live and running, so I don't really come back and check on these ones. But yeah, so I would probably take this out. I would take this one out because of cap. Let's just apply one on market cap, right? Let's say market cap over 2 billion. Okay, over 2 billion. Yeah, we can down to 18. So I think, yeah, those two companies I've taken out. So yes, that's my portfolio. This is combination sequencing for growth stocks. Now, let's say if I'm a day trader, what would I focus on? I'm not saying I am, but relative volume was also discussed. The term relative volume was discussed because day traders, especially for day traders, relative volume, time and again, from all the research that I've done, from all the stock market grades that I've listened to, relative volume is a very important indicator for day traders, right? So what I do is, my filter for day traders is, I'd say average volume of about 2 million. Now this is understandable, it's not rocket science, right? Because it's day trading, you want to look at volume is going to be a major filter, because the volume and how the price act will tell you how the market is running. Increased volume on lower price is obviously saying that the market is going down, at least for that stock, right? So you say over 2 million and relative volume, let's say over 2, right? You're already down to 49 stocks, and you're saying change from open, right? The difference between today's open price and today's last price. What has happened in a days of market being operational. So change from open, I'd say over 2%, up by 2%. Again, you can put out different ranges. So if you say up by 5%, okay, let me just first say, let's say up by 5%. Ooh! 12 of the stocks. Yeah, probably up by 5% is a better indicator. So here you have your 12 stocks, which you can find, you can closely track. But again, if it's day trading, you obviously want to bring down this list further on. So let's say, I don't think this would make a big difference. Price estimate. Oh no, it did. Oh yes. Now you have two stocks that you want to focus on as day traders. Okay, this is decent enough. I think 2 is enough. I think average true range is another thing that you can apply at, because you know what average true range is: maximum of the highest, lowest of the lowest, and the difference between the two. So if you say average true range, let's say over 1.5. Oh, both of them stand that way. Let's say over 1. Say, oh yeah, but over 1.5. Look at that. Again, I did the same mistake. So 2. Oh, that's more volatile. Yeah, let's keep it over 1.5. I think 2 stocks are easier to follow, keep track of. Yeah, so that's it from my side. There are 3 ways. Let me summarize again: quick bucketing and shadowing, which uses the heat map here. Quick bucketing is again just pick out, choose, make your list. Shadowing is where you choose your base company, choose wisely here, and then try and apply your filters to ensure that your base company reflects in your filtered list. And the 3 is a combination sequencing, wherein I've showed you 2 ways of finding good stocks for growth strategy, where you're looking for growth companies, and the second one is for day traders. So let me know how you like this video. Do let me know if you want further information or further detailing on any of the other aspects of Finviz.com. Till then, bye.